Hi everyone, my name's Gord Hart, and I am an advisor at Selectpath Benefits and Financial. We're here to welcome you to the third podcast webinar that we are offering to our clients. This one is titled Benefits Administration, and today we're going to go through administering a group insurance plan, some of the issues that you face as a plan administrator, but also some liabilities that you want to avoid and ensure that your program operates efficiently, effectively. So today's agenda, we're going to cover administration overview, the life of an employee, premiums, plan member enrollment, claims, administration pitfalls, and documentation. Within the group insurance realm, there are many types of administration. There can be head office, paper-based administration, internet online administration, electronic file transfer with higher data security, intranet if you will, self-administration, where the plan administrator performs all of the record-keeping services, and third-party administration, where we outsource the administration of the program to a third party. There are some fundamental principles to employee benefit plans, and some of these include that an employee must be actively at work to be covered, that the choices and amount of coverage is restricted based on the contract stipulations, and that if there are employee contributions, if they're required, they may be deducted from pay. There are a number of roles with a group benefit plan, and some of the key people or stakeholders in the program include the employer, the employee, the plan administrator, the insurance carrier, and the consultant. In terms of the life cycle of an employee, it starts with eligibility. And eligibility can be managed in your contract as mandatory, meaning that all eligible employees must be enrolled, or optional or voluntary, if you will, where the member has an option to enroll in the program. Within the small group market, meaning employers with less than 50 employees, typically plans are underwritten on the mandatory basis. Eligibility also defines what an employee is. And what we mean by that can be class structure, the type of work that they do to qualify, also the employment agreement that you have with the employee. For most group insurance contracts, the eligibility also requires a minimum number of hours worked. This helps avoid significant administration of taking people on and off the plan, but also extending coverage to members who may not be permanent full-time members of the organization. Province of residence is also important for eligibility, since each province has their own provincial program, and the benefit plan must integrate properly. Also, in some provinces, like Quebec, there are some restrictions over how the plan is designed and what you can or cannot limit within your prescription drug program. Adding an employee typically requires information on the employee, and in the group insurance industry, it generally reflects positive enrollment, which means we must know everything about the employee and the covered dependents, including dates of birth, gender, wages, province of residence, whether they have dependents or they're single, and potentially, if divorced, are their dependents still to be covered. Signatures are required to ensure that a beneficiary is named, since it is a contractual obligation to pay life insurance or AD&D payouts to the named beneficiary. Changes to the employee information happens periodically. An organization must set up a process to ensure that they change the information and ensure that the members understand how frequently that information is changed. For example, salary information. Organizations may choose to change that as their wages change throughout the year. Some organizations may choose to establish that salary as a report to the insurer at the end of the year based on T4. Each organization must have their own process, and the insurer must understand that process in providing coverage. Changes to employee information also includes life events, and these life events may be marriage, divorce, birth of a child, death of a dependent, or change of spousal coverage. Group insurance contracts typically require a 31-day notification of this change. Failure to notify within the 31 days may leave the plan member out of luck as it relates to their coverage changes they desire. Termination of coverage is very important, since most benefit plans require, again, a notification within 31 days of the change, but also terminating an employee is a stressful time. So you must remember to take the individual off the benefit plan, since keeping them on the plan may result in an unintended liability as it relates to coverage. In terms of life cycle for adding an employee, part of the life cycle of an employee is adding an employee to the benefit plan. For plan administrators, it's important they understand that they must do this within 31 days of eligibility. Failure to do so will result in late applicant status. When adding an employee, it's important that the employee name a designated beneficiary. That designated beneficiary should be over the age of 18. Choosing to name dependents under the age of 18 typically requires the naming of a trustee or guardian for those dependents. Failure to do so may result in the province stepping in as that trustee or guardian. When you're adding an employee, there's typically a waiting period. For most plans, it's 3 months. You can choose to waive the waiting period if you're trying to attract and recruit an important employee. But if you're going to waive the waiting period, you must waive all of it. You cannot waive part of the waiting period. Naming dependents is very important as well. Not only naming the spouse and dependent children with their dates of birth and genders, but also the province of residence. It's also important to understand whether there is spousal coverage. An employee may choose to waive health and or dental if their spousal coverage is better than the plan they are enrolling in. In the case of separation or divorce, it's important to understand the requirements to continue to cover dependents. There may be an agreement that requires a continuation of benefits, and if so, organizations, plan administrator, and plan members must abide by it. The challenge then comes where there is a new dependent to be added. For most benefit plans, you can only have one spouse. So it is important that the dependents and the plan members understand their obligations. When we're adding the employee or changing the employee, salary adjustments are very important, especially where benefits are determined based on wages or salaries. In some cases, enrolling an employee may trigger medical underwriting as it relates to their coverage over a non-evidence maximum. Typically, benefit plans will provide coverage up to a non-evidence maximum. To receive amounts over, you must provide evidence of insurability. It is incumbent upon the employee to complete that information, but it is important for plan members to be aware of this requirement, and plan administrators should make a habit of auditing their billing statements to see where people may be ceilinged at the non-evidence maximum. Premiums are typically determined on a monthly basis. It is uncommon to prorate premiums, which means when adding or deleting an employee, it's important to understand the crossover point when a billing cycle is generated. Often, if you terminate an employee within a certain period of time of the month, you will not have to pay premiums for that employee. Once you add them beyond that trigger point, you will be paying the full premiums, whether they stay for the full month or not. The life cycle of an employee includes life events. As stated earlier, there are changes that occur to your employees and the plan members, and it's important that those changes are reported in a timely fashion, again within 31 days. Some of the changes include salary adjustments. It can include moving from single to family or back to family when there's a change in spousal or dependent coverage. Adding and removing dependents. understanding the criteria in which a dependent is covered. For most benefit plans, a dependent child can be included up until age 21 or 25 if still full-time attending post-secondary institutions. Again, one spouse covered. You cannot have multiple spouses on a plan, so it is important to understand that restriction of continuing coverage for a spouse. Integration with government programs as well. Ontario drug benefit kicks in at age 65, and so understanding that change often occurs within a benefit plan to force the government to be first payer. Spouse is at age 65, typically is that trigger as well. And again, late applicants. It is important to understand that the insurance company may restrict coverage for individuals who have changes that are reported beyond the 31-day requirement. Changes in hours worked is also important to manage and report back to the insurance company, since that is, again, a critical piece of eligibility. Part of the life cycle of an employee is termination. How long do you continue coverage? Well, in most jurisdictions, there are employment standards, which will require you to provide a reasonable amount of notice. Typically, during this period, benefits must be extended. Coverage often continues during the notice period beyond the last day worked or in working notice up until the last day worked. Coverage is typically terminated at midnight that last day. For retirement, it's important to understand that benefits typically terminate on the date of retirement, that last day worked. The question is, do you extend it to the end of the month or the end of the year? Again, eligibility will dictate when to terminate an employee. If you choose to extend coverage, then you must get appropriate approval from the insurance companies to extend coverage beyond the legal responsibility as laid out by employment standards. In some cases, the insurers may choose not to extend certain benefits because of the risk associated. For example, out-of-province, out-of-country coverage. Again, on the life cycle of an employee, termination during a leave of absence. Typically, where there's a leave, the insurance companies require that the plan administrator ask for approval on extension. Some benefits may not be extended during that period. There may be exclusions. There may be limits to what activities that individual may participate in during the leave. In any situation, including maternity and paternity leaves, it is important that the plan administrator reach out to the insurance company and seek approval on that extension. How long that extension is and whether it is approved or not, that decision will typically rest at the feet of the insurance company insuring the risk. In addition, one of the concerns for a life cycle of the employee is the long-term disability pre-existing conditions clause. While typically this only arises at adding an employee, it is important to understand that clause as it relates to limitations on long-term disability for an employee within a certain period of being on the plan due to a condition they were actively treated for prior to enrolling. Each insurer will be different. It's important to understand this element of your program. Termination of a benefit, like disability, is very important to understand the risks associated with that change. For example, understanding the last day worked, the salary and coverage on that day, and the communication is key. As an employee is disabled, the insurance company will adjudicate and pay the claim based on the information provided, which also includes the salary information on file at the date of disability. Once a disability claim is in process, there is communication between the plan member and the insurer, but also the employer in terms of the approval or decline of the claim. Oftentimes, it is the plan member who's looking at the employer for help in managing the claim. Due to privacy, typically, plan administrators and employers have limited access to information. When determining a disability claim, it's important to understand the definition of disability because it is the primary driver of whether a claim is paid or not. And for most benefit plans, for the average employer, typically they use an own occupation period for an initial time period, like 24 months. During this period, a plan member must be able to prove they are unable to do the occupation for which they are trained, skilled, and employed. When a claim is paid, the insurance company reserves the right to offset payments based on workers' compensation, Canada Pension Plan, and other payees. Indirect offsets are elements like Canada Pension dependent benefits. Rarely are disability plans integrated with CPP child benefits. Some benefit plans include a cost of living adjustment, which will allow the payment to be adjusted based on a factor, which is typically CPI or a percentage, whichever is lower. That ensures that while someone is on claim, the disability benefits increase with the cost of living to help reduce erosion on the benefit payout. Another element of the lifecycle employee is termination for layoff. And again, in each jurisdiction, there will be a requirement for benefits to continue during the layoff period to qualify for a layoff. Each jurisdiction may be different, but it is important to reach out to the insurance company to request the extension for benefits and seek approval, thereby understanding what benefits will continue and perhaps what benefits might be excluded. During a strike, again, it is important for the plan administrator to reach out to the insurer to understand what benefits can be extended and what potentially the impact will be for the plan members who may not have coverage during a strike period. So we've talked about terminating members. What happens when they come back? Well, for most benefit contracts, there's a reinstatement of coverage provision. And oftentimes that means that within 6 months of the termination date, employers could reinstate an employee within that 31-day window on that active return to work. This reinstatement also avoids the pre-existing conditions clause in which benefits may be restricted for new members. Since the member is being reinstated, we don't have that risk. Termination for benefits also takes into account termination due to age. Many benefit plans include a termination age in which the benefits cannot continue beyond that birthday. It is also important to understand the legal ramifications of severance as well as employment standards as it relates to notice periods. While many labor lawyers make suggestions regarding the extension of benefits, it will be the insurance company that determines what coverage will continue and for how long. So during any negotiations or research on severance, it is important to reach out to your benefits consultant to receive guidance on extension of benefits for the period you wish to write into a termination agreement. Premiums is what make benefit plans work. It is the cost associated with the coverage. For benefits like life and accidental death and dismemberment, the rate for those benefits are often reflected as a rate per thousand of coverage. For dependent life insurance, the insurance company typically uses a flat rate charged only to the employees who have eligible dependents. Long-term disability, the rate is typically based on a rate per 100 of coverage, or in some cases, a percentage of payroll. For weekly indemnity or short-term disability, the rate is typically displayed as a rate per $10 of coverage. And for health and dental, the rate is typically determined based on single or family, which can be a member plus one dependent, and in some cases can include couples, which would be 2 adults, or single parent, which would be the member plus dependent children. Premium payments are required to the carrier. Typically, premiums are calculated and paid in advance of the period of coverage. Insurance companies will have differing payment terms, contract to contract, but often, once the payment is later than 31 days, potentially, the insurance company can suspend claims. Of course, suspending claims impacts the members. So it is important that the plan member and the plan sponsor, the employer, understand the terms of their contract. When conducting a plan member enrollment, birth dates are often the key element used in adjudicating the claims. Incorrect dates can result in declined claims since it is positive enrolled, meaning the insurance company will only cover those that are identified in the enrollment process. Beneficiary designations for the life insurance or applicable accidental death and dismemberment coverage can be revocable or irrevocable. Revocable means that a change can be made at any time by the plan member naming the beneficiary. Irrevocable means that a plan member is only able to change the beneficiary with the approval of the named beneficiary. Typically, we recommend only making revocable beneficiary designations. It is important that the nominations are clear in the forms, since these forms will be used in a case of a dispute on a payment. Naming an estate will trigger a payout through probate. What that means is that there will be an additional taxation to the beneficiaries on the payout. So it is important that plan members name a stated beneficiary to avoid probate taxes. When enrolling and naming a beneficiary, you can have a single nomination of beneficiary, you can have multiple, and you can choose how to split it as a percentage. When naming a minor under the age of 18, you can name the dependent as well as a trustee who will be charged with managing the funds for the minor. It is important to understand that that trustee is obliged to ensure that those funds are used in a suitable manner for that dependent. Once that dependent becomes the age of majority, they will then have access to the funds directly. As stated before, in the plan member enrollment, there can be an evidence of insurability. This evidence of insurability is typically required in any case of optional life and typically required for any amounts over the non-evidence maximum. We commonly see evidence of insurability come into play on basic life insurance and long-term disability, and sometimes short-term disability, depending on the amount of coverage. Once the forms have been completed and submitted to the insurance company will then notify the employer when an evidence has been approved, and only then will coverage move to a higher amount, thereby requiring a change of premium and potentially a change of payroll deduction. Failure to satisfy the evidence of insurability will mean that the plan member will maintain coverage up to the non-evidence maximum. Insurance companies will not reduce benefits based on the information supply. One of the concerns that a plan administrator or an employer might have in a change of insurance company is the medical underwriting. And it's important to note that under CLHIA guidelines, coverage changing between insurance companies must be grandfathered. And what this means is when change occurs, existing amounts are grandfathered without evidence of good health. Therefore, plan members cannot lose coverage in changing insurance companies. Typically, the insurance companies require copies of the prior insurer's billing statement to guarantee the coverages remain the same. Claims are another element of the life cycle of an employee benefit plan. Claims for life, accidental death and dismemberment, and dependent life insurance require a completed claim form. There is a lookup to the current named beneficiary. There may be a requirement for a proof of death, which may be a funeral home statement or a coroner statement, where there is a question about whether it was an accidental death or natural death. In addition to the grandfathering of coverage on a change of carrier, the new insurance company typically wants to have a list of those not actively at work. While the claims for those individuals may still stay with the prior insurer, the new insurer needs to know who they are, so if and when there is a return to work, they have the information to enroll them in the program. For long-term disability and short-term disability, typically it's a 3-part form. The form includes an employer statement, an employee statement, and a statement of the physician or specialist. Typically, the insurance companies want to know if it is a WSIB claim. Since most group insurance contracts are second payer to WSIB. Once a claim has been granted, payments are made at regular pay periods, which can be weekly, twice a month, or monthly, depending on each insurance company's claims paying practice. If and when you change insurance companies and you have disabled members on the plan receiving payments, a change of insurance company will not change the disability payments for those individuals. The prior insurer will continue to hold the responsibility on disability payments. In the case of a reoccurrence where an employee returns to work after disability and then goes back off, typically within 6 months, it is the same insurance company responsible for a claim. Once an individual stays at work 6 months or more in a change of insurance company, the new insurer would then be responsible for a subsequent claim. Health and dental claims are often completed electronically in the case of a drug claim with a drug card, electronic data interchange in the case of a dental claim through a dental office, and oftentimes electronic data interchange with paramedical practitioners, i.e. massage therapist, physiotherapist, or chiropractor if they've signed up for the EDI system. Where there's no electronic submission, typically there are claim forms required, or in some cases, smartphone apps that will allow members to take pictures of the claim and electronically submit it to the provider for payment. In some cases, the claim form must be completed, signed, original receipts attached, including a proof of purchase. Additional information may be required in the case of durable medical equipment, i.e., may require a physician's prescription. Electronic claims, which are typically the method of claims submission today, do have random audits. Therefore, it's important that plan members who submit their claims electronically maintain the records for a minimum of 12 months in case of an audit. So we've covered eligibility, we've covered change, we've covered claims. So what happens when things go wrong? So here are some of the administrative pitfalls that can occur while managing a group insurance plan. First is a late applicant. A late applicant is a plan member who is enrolled beyond 31 days of the date they are eligible. In this case, an insurance company may reserve the right to restrict elements of the coverage or access to coverage completely. Another pitfall is incorrect salary amount. If your benefits are determined based on wages and an incorrect wage is submitted to the system at claim time, the beneficiary of that claim will be paid out based on what is reported. Alternatively, the insurance company reserves the right to audit payroll records. So in some cases, if a plan administrator has disclosed an amount higher than actual, the insurance company does reserve the right to pay the lower of what is reported and what is actual. A significant liability or pitfall is the extension of coverage to inactive employees beyond a reasonable notice period as outlined by employment standards. Failure to notify the insurer of an extension beyond the Employment Standards Act could result in a claim being declined, which then could in turn result in a liability for the employer if the extension beyond employment standards was part of a severance or termination agreement. Allowing ineligible employees on the plan is another risk. Employees with significant fluctuation of hours may choose to enroll in the plan, consume heavily, and then be removed from the plan when they fail to meet the minimum hours required. This type of anti-selection behavior can be avoided by making sure that only eligible plan members who meet the minimum standard are enrolled. Changes in plan member classifications is also important. Perhaps you have an employee who changes their job and transfers from one part of the organization to another. In those cases where there is different coverage, it's important that that transfer be communicated to the insurer to avoid loss of coverage or a liability associated with lack of coverage. Travel insurance within group benefit plans is typically managed under a stable and unexpected basis, meaning a claim is often paid only if the illness or injury was unexpected and only if the plan member was stable before they travel. It is important for plan members to understand that travel typically requires that the destination be an eligible destination, meaning war zones or travel advisories suggest that the plan member not travel to those regions. If any question exists as to whether the coverage will be in force for travel to certain regions, we strongly recommend the plan member reach out to the insurer to get confirmation of coverage eligibility during a visit. Many of these pitfalls for plan administrators revolve around data points and revolve around late applicant and management of the information. This is why we often recommend some form of human resource information system. Harnessing the power of technology, plan administrators can make changes in one system that populates all of the systems, including employee benefit plans, payroll, and employment records. For those plan sponsors interested in learning more about human resource information systems, feel free to reach out to us and we can give you some more information. Documentation is the last piece on understanding the structure of an employee benefit plan. Benefit plans are contracts. They're contracts between the insurance carrier and the plan sponsor, the employer. In essence, they're a promise. It's important that you have copies of the contracts. It's important to understand those contracts completely. They will form the decision point on eligibility and payment of claims. Employee booklets and brochures are an important element of your employee benefit plan. Legally, these documents are seen as part of the employment contract. So it is important that plan administrators make sure that the booklets are accurate and kept up to date with changes. It is also important to be careful in creating your own internal documents, as errors in these documents could result in a liability associated with extension of coverage beyond your contract with the insurer. Carrier websites are a fantastic resource of wellness information, downloading forms, as well as downloading booklets. In tandem with the carrier website, most insurers have some form of smartphone application. These apps typically include eligibility information, can include access to claims history, plan design, policy numbers, and contact numbers. There are no costs associated with these apps, and we find higher engagement of plan members who use these technology tools. Additionally, employers can use their own intranet site to host information for the plan members. The challenge will be making sure the information is up to date and accurate. Again, a great solution is a human resource information system that can be populated from the insurer directly to your program to make sure the information is timely and accurate. This ends our podcast. Thank you for joining us today. If you have any questions, feel free to reach out to us at Selectpath Benefits and Financial. Thank you for your time.